welcome to the deep dive. Back in the mid-'80s, if you claimed you could consistently beat the stock market, well, let's just say the academics weren't exactly cheering you on.
No, they weren't. The dominant idea then was the efficient market hypothesis, the EMH.
Right, the idea that stock prices always reflect everything instantly, so any success is just luck, coin flipping, basically.
Exactly. They literally called successful investors coin flippers. It sounds kind of dismissive now, but it was serious academic theory.
But today, we're diving into the moment that idea got seriously challenged, maybe even demolished. We're looking at Warren Buffett's 1984 speech, The Super Investors of Graham and Doddsville.
Yeah, this speech is fantastic. Our mission here is to unpack how Buffett used, actual audited data, not just theory, to show that skill, rooted in a specific way of thinking, was behind some incredible long-term success stories. He essentially flipped that whole coin flipper narrative.
Okay, so how did he start? I love how he didn't just argue against the coin flipping idea. He sort of used it, right?
He did. It was brilliant, really. He asks you to imagine this massive national contest, 225 million Americans. Everyone flips a coin once a day, betting $1.
Okay, simple enough.
And after, say, 20 days, purely by math and chance, you'd end up with about 215 people who'd won every single day. Millionaires just from flipping coins.
And those 215 would probably start giving seminars on their amazing coin flipping technique.
Probably. And that seems to prove the EMH point, right? Random chance creates winners.
But then comes the twist.
Exactly. Buffett says, okay, what if you looked closer at those 215 winners and you found that, say, 40 of them, a huge chunk, all came from one tiny town? Or even better, his analogy, a single zoo in Omaha.
Okay, so if 40 winners came from the same place, you wouldn't just shrug and say, wow, lucky zoo.
No way. You'd immediately think, what's going on at that zoo? What are they eating? What's the zookeeper doing? You'd investigate the cause, not just attribute it to random luck.
And that zoo, in his analogy, was the intellectual village of Graham and Doddsville.
Precisely. He argued this is what happened in investing. A hugely disproportionate number of the most successful long-term investors didn't come from the same place, but from the same intellectual origin. They were all students or followers of Benjamin Graham and David Dodd.
And he backed this up with numbers. Real audited track records.
Oh yeah, the numbers are key. Our sources really emphasize this. We're not talking about beating the market by a little bit. Look at the Buffett Partnership, LTD itself, over 13 years. It outperformed its benchmark by an average of 16.4% per year. That's the alpha.
16.4% alpha compounded. That's astronomical.
It is. Or Pacific Partners, run by Rick Guerin, another Graham disciple, generated 15.8% annual alpha over 18 years. You see numbers like that clustered around this one intellectual school. Well, the random chance argument starts to look pretty shaky. You have to ask, what was their secret sauce?
Okay, so let's get into that secret sauce. What were the core ideas coming out of Graham and Doddsville? It all goes back to their book, Security Analysis from 1934.
That's the bedrock. It basically tried to turn investing from, pure speculation into something more like a disciplined profession.
And the absolute cornerstone principle.
Margin of safety. It sounds simple, but it's profound. You only buy a stock, a piece of a business, when the market price is significantly below your own conservative estimate of what that business is actually worth its intrinsic value.
That gap, that discount, is your protection.
Exactly. It's your buffer against being wrong in your calculations or just, bad luck, unexpected events.
And this completely flips the academic definition of risk on its head, doesn't it? Academics were all about beta, price volatility.
Right. High volatility equals high risk in their view. But Graham and Buffett, they said, no. Volatility isn't the real risk. The real risk is paying too much and permanently losing your capital.
So a bigger margin of safety actually means
lower risk. Because you have a bigger cushion protecting you from overpaying and suffering a permanent loss.
The classic example he used was the Washington Post back in '73. The whole company was selling for maybe $80 million in the stock market.
Yeah, but Buffett and Graham looked at the actual assets, the TV stations, the newspaper, its earning power, and figured it was worth, conservatively, at least $400 million. Maybe more.
So if the stock price then dropped by half, an academic would say, see, risky.
But for the value investor, the risk actually decreased, because the price just got even cheaper relative to that $400 million value. The margin of safety got wider, The chance of permanent loss went down, not up. It's a totally different way of thinking about risk.
Okay, so margin of safety is the financial protection. What about the psychological side? That's where Mr. Market comes in.
Yes, Mr. Market. Such a brilliant allegory. Graham pictured the stock market as this sort of manic, depressive business partner you have.
Every day he shows up.
Every single day. He shows up at your office door and offers to either buy your share of the business or sell you his share. And the price he quotes is, well, all over the place, based purely on his mood.
Some days he's euphoric and offers a ridiculously high price.
Yep. Other days he's terrified, convinced the world is ending, and offers to sell you his share for peanuts.
And the lesson is,
You are free to ignore him completely. Or you can take advantage of him. Buy from him when he's depressed and selling cheap. Maybe sell to him when he's wildly optimistic. But the crucial thing is, you never let his mood, his crazy prices, influence your own judgment of what the business is actually worth. His irrationality is your opportunity, not your guide.
which ties right into the third big idea. A stock is a business.
Exactly. It's not just a blip on a screen, not just a ticker symbol, not something you trade based on charts or, what some pundit said yesterday.
You have to think like you own the entire company.
Right. Would you buy an entire farm based on last week's weather forecast? Or sell your whole apartment building because someone offered you 10% less than yesterday? No. You focus on the long-term economics, the management, the competitive position. That's the owner mindset.
It's clear these principles are powerful. But what's also fascinating is how the super investors applied them in pretty different ways, yet still got amazing results.
Oh, absolutely. There wasn't just one rigid way. You had different styles, different temperaments, all operating under that same Graham and Doddsville umbrella.
Let's look at the extremes. You had Walter Schloss.
Walter, the quantitative Puritan, as Buffett called him. He was pure old-school Graham. He basically looked for cigar butts.
Cigar butts, meaning...
Like finding a used cigar on the street with one good puff left in it. Not glamorous, but it's a free puff. Schloss bought tons of stocks, like over 100 sometimes, that were statistically incredibly cheap, often trading for less than their net working capital, basically getting business for free.
And he famously didn't care about the business story, right? Didn't even talk to management.
Nope. Avoided it. He thought it would just cloud his judgment with persuasive talk. He focused solely on the numbers, spread his bets wide, and relied on the statistics working out over time. And his results were phenomenal, 21.3% a year, pre-fees, for decades. His edge was pure discipline and temperament.
Okay, so that's one end,
Yeah.
super quantitative, diversified, almost mechanical. Then you have the other end, Charlie Munger.
Right, Buffett's longtime partner. Munger really pushed the thinking forward. He wasn't as interested in those cigar butts. He famously said it's better to buy a wonderful business at a fair price than a fair business at a wonderful price.
Quality over cheapness, in a sense.
Exactly. Munger's big contribution was really emphasizing the importance of a durable competitive advantage, what they call the moat. He saw that as the ultimate margin of safety, but it was more qualitative. Can this business fend off competitors for decades? That became the key question.
And his performance was also stellar, around 19.8% annually. So two very different approaches. Deep statistical cheapness versus durable quality, but both rooted in that core Graham idea of value versus price.
It shows the flexibility of the core principles. Find the gap between price and value, understand risk properly, and have the right mindset.
But having the right intellectual tools isn't enough, is it?
Yeah.
There's that crucial cautionary tale in the speech. Rick Guerin.
Rick Guerin, yes. This is maybe the most important part for understanding the temperament required. Guerin was brilliant, absolutely brilliant. His early returns were even higher than Buffett's or Munger's for a while, something like 32.9% per year pre-fees.
He clearly understood the Graham and Doddsville playbook.
Totally, same intellectual foundation. But as Buffett put it, Guerin was simply in a hurry to get rich.
And that led him to use
Leverage. Margin loans. He borrowed heavily against his stocks to try and juice those already fantastic returns even higher.
which works great until it doesn't.
Exactly. Then the nasty bear market of 1973-1974 hit. Stocks plunged, and Guerin started getting margin calls. He had to sell.
He was forced to sell valuable holdings, like Berkshire Hathaway stock itself, at the absolute worst time, at rock-bottom prices, just to cover his debts.
Oh, right. That leverage turned what should have been a temporary paper loss into a permanent, devastating loss of capital. He had the brains, but not the patience or the risk aversion when it came to borrowing.
It's such a powerful lesson. The number one goal has to be survival. avoiding that risk of ruin.
Absolutely. Garen's story proves it. Leverage negates the margin of safety. It takes the control out of your hands. Risk management isn't just important, it's everything. You have to be able to withstand the storms.
So, pulling it all together, whether it was Schloss buying statistically cheap cigar butts or Munger looking for high-quality moats, the common thread was always that search for a difference between the business value and the market price.
That's the core. And Buffett argued this opportunity persists simply because of, well, human nature.
People making easy things difficult.
Yeah, that perverse human characteristic, as he called it. Emotions, fear, and greed will always make Mr. Market behave erratically sometimes. As long as people chase fads or panic sell, there will be mispricings for the disciplined, rational investor to find.
He said the flat earth society will flourish, right? Meaning people will always believe silly things, and those who stick to Graham and Dodd's logic will benefit.
Pretty much. The opportunities won't disappear just because the academics declare the market efficient.
And it's interesting how this connects to Buffett's advice for most people today.
Right. He's very clear. If you don't have the time, the interest, or, crucially, the temperament to do the deep analysis and withstand the psychological pressure,
Then just buy a low-cost S&P 500 index fund. Forget trying to be a super investor.
exactly. It's intellectually consistent. If you can't find or exploit those mispricings yourself, then the most rational thing to do is own the whole market at the lowest possible cost and accept its return. It's an admission of limitation, which is also a hallmark of Graham's thinking.
And we still see these Graham and Doddsville principles playing out, even on a huge scale, like Buffett's big investment in Japanese trading companies a few years back.
Oh, that was classic. In 2020, Berkshire bought big stakes in 5 major Japanese trading houses, the Sogo Shosha. Why? Because, as Buffett said, he was just amazed at the low prices of their stocks.
So what did he see?
They were diversified conglomerates, solid businesses, often trading below their book value, paying good dividends, high earnings yields. It was like finding giant, high-quality cigar butts on a global scale. Pure Graham and Dodd value logic applied internationally.
It really brings it full circle. The ultimate takeaway from the super investors of Graham and Doddsville isn't about complex formulas or inside information.
No, not at all. It's about having a sound intellectual framework, margin of safety, Mr. Market, thinking like an owner, and then, crucially, having the right psychological makeup. The patience, the discipline, the independence to ignore the crowd.
Emotional fortitude, really.
That's a huge part of it. Can you stick to your analysis when everyone else is panicking or getting euphoric?
So, maybe a final thought for you to consider, building on this. If we accept Munger's point that perhaps the best margin of safety today isn't just statistical cheapness, but the quality and durability of a company's competitive advantage, its moat.
Then the question becomes, what's a business, maybe one you own or are thinking about, where you genuinely believe its competitive moat is so strong, so durable, that it has a very high probability of not just surviving, but thriving over, say, the next 20 years? Something to really think about.